Good day once again. Today we'll be discussing to you the part 2 of financing on business growth. On part 1, we discussed to you the importance of knowing how to make use of your finance when you intend to grow your business. I hope that you were able to understand fully well, and this time we'll give you the part 4, which is about a continuation of a discussion between debt and equity and the source of financing. As what we have discussed yesterday, the other day on the part 1, we fully elaborate what is debt and what is equity. This time, we'd like to discuss to you how it is being compared and contrasted. So, debt versus equity. Let me read you a very important discussions in order for you to understand fully well. Then I can explain to you and give you some examples. When we talk of debt versus equity, there is no exact recipe for the best debt and equity mix. Therefore, the right mix must maximize the growth in a long-term profit. This mix is likely different from each individual situation, but for most it will be applicable for startups. Startups particularly with SMEs, which are small, medium enterprise, or even a micro one. All the micropreneurs, all the SMEs may lose money in their initial years. Entrepreneurs experience problems on finance, especially in the first, second, and third year. And because they have neither their cash nor much collateral to support their debt, startups mostly need equity to enable the growth. So take a notice on this. We are talking about this time how equity is important between debt and equity. This time I would like to make you know that debt and financing equity should not be seen as substitute for each other. Instead, they are very different in nature and complement each other. In other words, if we need additional capital of our business, we do not have to say that debt is better than equity financing. It depends on the situation. It depends on your size. It depends on your status of your business. So we need to choose. It's either we go into debt financing or equity financing. This depends on individual circumstances, as what I've said, and the opportunity, the trick for each investment to find the best mix of both. So with this discussion, we'll find out what would be the best for us, what would be the best for you if you're going to obtain loan, if you're going to add more capital. Let us know in the next slide the sources of financing. Here are the sources of financing, but this all will depend on your decision. The first source of fund in your business growth is the 3 F's. We call it the family, friends, and fools. The second, customers and suppliers. The third, the retail banks or the commercial banks. Government backup loans. The credit cards, but take note, this will be the last recourse by using your credit card. Another is an angel investor. Let us know what do we mean by 3 F's. Okay. SMEs or small medium enterprise owners usually approach and firstly from their members of the family, their friends, which they should require more capital. They are the first people that you are going to tap. You are going to ask for help. But this doesn't mean when we say fools, these are not actually the foolish guys, but the people that will entrust their money to you for an unforeseen investment. So that may be the meaning why they say it fools. But it is 3 F's: family, friends, and fools. Because any person that is going to entrust their money to you, they don't know what will happen next. The next, where we can also have our loan or we can have a backup source of finance, is from our customers and or to our suppliers. Entrepreneurs can obtain loan from their suppliers by creating a credit line. Yes, if you have established a good relationship with your suppliers, you have a good behavior when it comes to paying your credits, then your suppliers can provide you a credit line. When we say credit line, they're going to give you a time element of either 30 days, 60 days, or 90 days, or even more. It depends on your agreement, and it depends on the trust of your suppliers. Also from your loyal clients, which you have also created a good relationship. Another source of financing is from the retail and commercial banks. But take note, banks have their own procedural in their company. They give you procedures, they give you requirements. And these financial institutions cater loans, but they require collaterals and guarantees. And this is for sure. You have experience borrowing money in financial institutions. They require you to provide a loan or a guarantee or as their security that you're going to pay back the loans that they have catered to you. Another, which is very, very, actually is more beneficial, is the government backup loan. Why I said it's beneficial? Because they charge a very minimum rate of interest. When they provide loans, when they offer loans, government has a very minimal interest, and also they require collateral and a guarantee, but also in a very minimal. And normally government backup loans, government institutions are a bit lenient when it comes to repaying. They give you more grace period, especially when they saw that your intention is really sincere and you can present to them your financial scenarios, so they can extend your loans with a very minimum interest. But it doesn't mean that we abuse to our investors, to our creditors, because we have all these chances to get finance in order for us to add capital in our business. Another thing is about when we talk of equity financing, I'll give you 2 options: the angel investors and the venture capitalist. What do we mean by angel investors? Angel investors is also called as business angels. They are individuals or a company that provide equity funding for your growth-oriented private companies with an aim of achieving a financial return. take note, they also aim to achieve financial return. It doesn't mean that if they are an angel investor, they do not expect you anymore to pay back the money. Through a capital gain and your exit. Normally, some of the angel investors, they can be a part owner of your business, which is very beneficial because they will help you in managing your business. They will provide you guidance, they will provide you counseling, they will provide you mentoring in order for you to manage your business. And aside from that, they're also part owner. Most of the angel investors are going to give you at least 3 years for you to take the opportunity of being there with them, financing maybe 80% of your capital investment, of the total capital investment, but they will also have an ownership of 80%. And they give you at least 3 years, depending on your agreement, that you can have the opportunity to buy the shares from them, to buy the ownership from them, I mean. So when, for example, they own the 80% of the financing or the capital, meaning their ownership is 80%, but in 3 years, not more than exactly 3 years, is for you to have the opportunity to buy the shares. In other words, they make it a point that you will make your business function well, be more productive, help you in managing your business, help you more to enhance your strength, and find out some solutions for your weaknesses in order for you to go through and to go forward with your business, so that in the end, after 3 years, you have the capacity or ability to buy the ownership that they have already taken on your business. Another is the venture capitalist, which is a contrast of an angel investor, because venture capitalists are private sectors who provide venture capital to promising business ventures. They typically invest where at least 25% annual return within 1 to 5 years are feasible, and often demand 50% of more ownership to exercise control over the investee. You are the investee. They are the investor. Venture capitalist becomes part owner, and they are even requiring you that you will have to offer them the 50% ownership. So this time, my dear entrepreneurs, is for you to decide if in case you need a growth of your business and you need a capital. We have, as I mentioned, the source of funding, the government, angel investors, friends, families, and fools, that's what we said. But these are people who are going to invest for you, who are going to trust you, though they don't know what's going on within next, in order for you to make your business grow. And this will help you succeed your business and be more responsible in paying back, and be more responsible to be aware of what are your obligations and commitment, as what we discussed in the first part of this discussion. That's all for today, and thank you.